Hi, I'm Lynn Adams. I'm here to give you a recap of our second quarter conference call. We just did this today as a webinar. This is sort of the recap version, so anything that I share with you today is for educational purposes only and is not intended to be used as an investment advice. All right, with that we get started. So this has been a quarter of chaos. I've seen a lot of very big down days and a lot of very big up days. Just pulled a couple of slides to share with you, some of the headline media events. The new Black Monday 2020. We actually had a worse day than that one. Even was down almost 3,000 points on the Dow, 2,900 or so. Also had Wall Street Journal report that we had one of the best days in a single day. 11% jump in one day is the best day since 1933. Obviously, there's a lot going on in the world that is causing the market to have this very widespread volatility. It's almost like we have a tug of war going on between the COVID-19 virus and all of the terrible things that come with that, along with a government that is unleashing its entire arsenal of weapons to keep the economy healthy and moving forward despite the challenges with the virus. This first slide here we'll talk about is essentially the long-term, the last 40 years or so of year-to-year volatility. What we've seen here is that, this loss of 34% this year from the peak to the bottom is a pretty big move intra-year. But, in the context of history, we've seen these types of moves on more than one occasion. In fact, in the last 40 years, you can see four other events of a similar intra-year loss. So in terms of the market and expectations for the market and pricing, certainly not something we aren't familiar with, but it definitely is always uncomfortable. So with that, let's talk a little bit about what's going on with the virus, because that's really the front and center driver of the market, because people are trying to extract the outcome of how this will turn out into, will corporations still function? Will they still make money? This is some data that was put out from JPMorgan. On the left-hand side here, you kind of see the number of cases in terms of where we were April 1st around the world relative to the number of folks that get it and then have a recovery relative to the fatalities that come with the virus. It is obviously a very, very serious thing going on, and each country is dealing with it in its own way. On the right-hand side of this same slide, you see that the growth in case count is actually varied. This is a weekly change in cases, so essentially you might see 1 week where you only have 100% growth from week to week, and then there's been other moments where it's 350, almost 400% in growth. So a lot of that has to do with the policies in place around the world and the hot spots and the areas that have been infected the most by the virus. The U.S. is, put social distancing measures in place and basically stay-home alerts by the states, and that has helped to slow the growth. The last week or so of data that is out there, it looks as if we're back down to maybe like 100% weekly growth versus the 200 or 300% weekly growth. One of the things that's difficult, though, is the fact that the mortality rate is really high. I mean, globally it's around 5%. So the more people that are impacted by it, not only is there terrible outcomes with fatalities, but it's really wrecking the world economy as well, because people aren't able to go about their normal business. So now in the U.S., the strategy seems to be, and this is from our associates up at JPMorgan who do a lot of data analysis, and we rely heavily on their opinion on data and trends. Their view is that in the U.S., the government's anticipation is they're going to slow it as much as they can to try to buy scientists time to find ways to treat it better, or perhaps a vaccine, but most importantly to slow the rate of people moving into the hospitals, because the folks heading into the hospitals that can get treated, the mortality is a lot lower number. In fact, if you take into account the cases that maybe are out there that haven't been reported, and you look at the number of fatalities relative to the actual number of cases, they believe that it's probably about 1% in the U.S. So when you factor that in, we've kind of got this sort of looming sense of the next year is going to be pretty tough. I mean, we might lose 1% of our population if we don't find a vaccine or get a widespread way of treatment in place quickly. So, there's a lot of emotional issues that come with that, a lot of fear, and a lot of people having to change their behaviors in pretty radical ways. But in terms of the market and investing, if you look at the impact just that we've seen, the industry groups that have been hit the hardest, this slide here shows you essentially the 5 industry groups that have been hit the hardest from an economic standpoint: retailers, restaurants, bars, entertainment, hotels, tourism, transportation. So that segment of the economy produces about 19% of our gross domestic product last year. So those industry groups are pretty much have come to a halt at the moment. I mean, there are some restaurants that are doing curbside and carry out, but the real large quantity of dollars and things are spent in areas that are shut down. And so that's a big dent to economic output in the U.S. If you look at it from just number of jobs, those 5 sectors employ 20% of all the payroll jobs in the country. So if you consider that 20% of the population doesn't really have work right now, and so it's not just those jobs and those industries, but they also have bills. They have rent, they have mortgage, they have car payments, they have child care, they have the things that they spend money on that if they're not working, they're not able to create the income to pay those bills. So there's sort of a cascading effect that tends to happen in our economy when you lose segments. So the outcome of that in terms of earnings and GDP loss is hard to predict at this point. When we look at just the earnings of those 5 key sectors, last year, the earnings from those corporations in those sectors was about 7% of S&P 500 earnings. So, you can't just say, well, 93% of those earnings will still be there. They won't, because the cascading effect of people in those industry groups that can't go about their normal business. So we've got a very significant economic slowdown. We are definitely going to be in recession over this. The government is trying to respond and fight this with monumental historic stimulus. So 2 weeks ago, they signed the CARES Act, and this slide here shows you a bit of the pieces of that, where there's stimulus to people that have been unemployed, there's stimulus to small businesses, there's stimulus to everybody from self-employed to mid-sized companies to large-sized companies. The state and local governments are getting backing. There's a lot of different pieces to this, but that's just one of several government responses. Immediately before this was passed, the Federal Reserve announced that it was reducing its Fed funds rate to 0. Unprecedented, historical, never ever done that. So core interest rates in the U.S. are now at 0. They restarted the quantitative easing program, which is what they used in the financial crisis back in 2007, 2008. They've essentially opened back up the troubled asset relief program. They are trying to flush money into the banking system to make sure that we don't have any sort of structural problems in the banking sector. When you take those 2 pieces, and then literally today there's another announcement of another $2.3 trillion of stimulus coming through the Federal Reserve in terms of monies going into different places, which we haven't really gotten into yet. But just those 3 pieces of legislation alone any one of them rivals anything we've ever seen on the government side for stimulus. If you look here on the right-hand side of this slide, you can kind of get a projection of just this year's deficit to budget. We're going to spend 13.6% in excess of what our GDP can create. And that's assuming that our GDP can create anything near what it created last year, right? If it creates less, then we might see that deficit spend be 20, maybe 25%. So these are historic moments. In fact, the only time in history that I was able to find when I go back and look at how many times have we ever spent such money in a deficit situation was in World War II. We had tons of troops and armament, everything going out to try to fight the war. And at that time, the government spent massive amounts of money in excess of its annual GDP. So, the government sees this as an unbelievable threat, and the response to it is to the same degree of what the government's response was to World War II. And interestingly, and sadly, the loss of life that may come from this may be similar to what the loss of life was in World War II before it's all said and done, because unless they find a quick and easy distributable cure or vaccine or treatment process quickly, just the rate in which the disease is spreading, it creates a very difficult situation to manage from a loss of life standpoint. So we've got a very difficult set of economic challenges. At the same time, we have a very difficult set of social challenges as well. So, from our vantage point, I mean, we obviously care about the cultural and social elements of this, but it's our job and our responsibility to help our clients navigate the financial ramifications of these things. So the question that we get above all else is, well, how should we respond? How should we respond to all this information as investors? So we just kind of want to put this presentation together to show, there's a few things here I think that are really important to kind of anchor your decisions in, all right, in terms of how you process all this information. And the first thing I think we all have to recognize is that big picture, long term, the American economy is a very, very strong engine. It is unquestionably the best economy in the world. We have the demographics for growth for decades. We have the efficiencies. We have a customer service standard that's unprecedented. We have we have a banking system that's totally engaged and rich with resources to fund it and back it. So big picture, long term, I think things are going to be fine. I think things actually will be great past the COVID-19 crisis, but this is a big, massive crisis that could last not just 6 months. It might last a year, it might last 2 years, it might last 3 years. It's hard to know. So what you have to do is stay focused on your individual goals. If you want to retire in 10 years and you need a certain amount of money per month and you plan on selling shares of things at an appreciated price to have the money to pay your bills, then you need to stay focused on that goal. How do I keep those type of numbers of shares of things high enough to provide for what I need in the future? I think another element in this is to realize that, okay, while pricing in the market and securities is down, there's a lot of opportunities to buy things here that you might not ever get to buy at these price levels again. Now, granted, it might be lower next week or the week after, but relative to where they will be in the future, or even relative to where they were 8 weeks ago, things are discounted pretty severely. So stay focused on your goal, your accumulation goals. Make sure that you understand the opportunities that come from this chaos, right? And the second principle is the principle of win by not losing. And that's almost it's a rally cry here for a lot of the work that we do, especially with our trend analysis. But the consequences of large losses are pretty substantial. And we'll take you through that a little bit more here in a minute. But before we get into that, let me kind of give you an example of some things that are impacting the market and how we take these two goals and we apply it logically to what's happening in the market. So first thing here is I'm going to show you a clip of basically, this was some footage captured by National Geographic. And I'm taking you back to a scene that happened in 2011. This is the initial part of this is a building shaking and the ceilings falling down, and it's a school building, and then it kind of zooms out to this view of where this is Japan, right? And this was a tsunami that was resulting from an earthquake out in the ocean. Within an hour, they had to move people to higher ground, and within an hour, these massive floodwaters surged into the coastline of all of northern Japan. And you see these folks, desperately trying to get to higher ground and get out of the way of this just unbelievable destructive path of just endless amounts of waves of water and trash and debris. And the world was watching this unfold, right? And within days of this event happening, it was a very, very horrendous event. I'm sure that even today that they haven't completely rebuilt some of the things that were damaged in that region. But as the world watched this happen, we saw the world stock market sell off nearly 20% in a matter of days, maybe 2 weeks tops. And the point of this, in the context of what's happening today, is that we see the world responding to COVID-19 in a similar fashion. We don't know what's going to happen. We know it's bad, it's horrible, and so we just know we should sell. We should sell. We should get out of harm's way, and we should brace ourselves for the worst of the storm. And when this occurs, this chart here maybe help you illustrate what happens is called a market dislocation. And a market dislocation is where the market price becomes dislocated from the fundamentals that drive the actual earnings of the companies represented in the market. So for example, if you look at 2011 on this chart, you can see there was a decline, a pretty sharp decline in the spring of that year, and that was in the U.S. And this is a chart of the S&P 500, not the world markets, but you can see that tsunami event just created that one trigger knee-jerk reaction. We all need to get out of stocks immediately. Now, as we all know, that region, the damage was contained, and the entire nation of Japan at the time represented about 2% of the world's population, about 2.5% of the world's total production and consumption. The world sawed off 18-19% of its entire world GDP was lost in that pricing anomaly, but things went on. I mean, it ended, and the recovery happened, and the market recovered. But the market sold off 20% of its value based on the loss of potentially a region that its entirety, the whole country, only produced 2% of the world's economy. So we see people overreact, and that's a big thing in the investment markets to understand, that people sell first, ask questions later, and it's emotional. All right, so fast forward to today. You can see on this chart right now, you see a steep market sell-off. Price to earnings ratios have dropped tremendously, and it also represents this emotional fear selling. Now, there's a flaw here in this chart, and that is that this is measuring the price of stocks relative to the earnings projections for the next 12 months. The moment we're in right now, we don't actually know what companies are going to earn for the next 12 months, because half the companies reporting have no guidance, because we don't know how much is going to get shut down or how long this will last, that kind of thing. But we do know that the selling was pretty spectacular in the first quarter. The U.S. S&P 500 was down 20%, and the EFI was down 26%. So somewhere between 20 and 26% is what the world stock market lost in the first quarter. So when we think about market dislocation, and this sounds horrible, but if we lose 1 or 2% of the world's population through this horrible disease, is that really going to trigger the world to contract its economic output by 20 to 25%? I think it's the same situation. It's an excess knee-jerk reaction. It's emotional. So we got to go back to our goals and how should we individually respond, right? So we know that this next slide shows that the losses that come are really the things we got to be careful of. It's not how much can we make, it's how do we win by not losing, right? While being mindful of our long-term goals is to own things that can appreciate. So in this chart, notice on the left-hand side, if an investor were to lose 10%, you'd have to make 11% to get back to whole. You have $100, you lose 10, you're at 90. Well, to get 90 back to 100, you actually have to make 11%. You need to make, you need to make $10, only $9 invested. If you were to lose 50%, $100 turns into 50. Well, get back to 100, you got to make 100% return. So one of the things we've learned over time is that we have to take extraordinary measures to underlay all of our strategies to really defend against the large losses. I mean, no one likes to lose anything ever. Most of our clients are down year to date through the end of the first quarter, down between 6, maybe 7 for the more conservative folks, and the more aggressive folks are down like 13 or 14. Those losses are about half of what the benchmarks for those types of risk return profiles look like in the industry. So, but because we only lost half of what most people have lost in most of our strategies, the return piece to get back to where we were is a so much smaller range that we don't have to really swing for the fences to just get back to even, all right? We know that the fear selling has occurred and it may continue to occur, but our strategy is designed to not lose as much as the market. Now, the flip side of that same coin, and this is put out from JPMorgan, and I think it's very, very true, and it's just interesting to look at both ways. If we believe that in 4 years from now, or any number of years from now, but I'm going to use 4 years from the chart to make an example. If 4 years from now the market will return to where it was just 8 weeks ago at its peak, okay? That would represent a 41% increase from the value of the market as of March 31st. So if we had total amount of just discipline and conviction and just patience, and we said we're going to buy the stock market, at this price level, and we're just going to ignore how bad it might get or what happens in the economy, if we have a recession, if it turns into a depression, whatever it may be, but we're just banking on the fact that in 4 years or so, it'll be back to where it was. Then if you did that and the market did get back to where it was in 4 years, that'd be a 9% per year average appreciation. And then on top of that, you'd get dividends because, like for example, the S&P 500 is currently around 2.7% dividend. So you'd literally have a 10% a year plus average annual return for the next 4 years. And 8 weeks ago, if I'd asked anybody, hey, how does 10% per year return for the next 4 years sound? Everybody'd say, that sounds great. That sounds great, right? But it's only in these moments of panic, fear selling that drives the market price down that we get these opportunities, right, to be able to create those upside moments. So balancing how do we not lose a bunch and also being able to invest and being able to participate in the upside, that's the art, that's the challenge. So this is where I'm going to turn the conversation over to talk about our trend strategy. Now, our trend strategy is designed to where we participate in the market when the market's above its 200-day moving average, and we want to be mostly or fully invested when it's above the 200-day moving average, and the conditions in the marketplace are what we consider normal, okay? Now, this trend strategy also is designed that when we move under the market's 200-day moving average, that we get out of the market before it falls off to larger declines that are more historic. So this chart shows us that we got fully invested using our trend strategy in March of 2019. At that point in time, the S&P 500 had been moving forward, and it got above its 200-day moving average by 3%, which was our trigger at the time. And we've been fully invested in the trend strategy, which is basically fully invested in stocks from March of 19 through January of 20. Okay. In January of 20, an interesting thing occurred, and that is that the market actually went over 10% above its 200-day moving average. So it didn't just stay in line with its average, but it ran up at such a pace that the price got up above 10% over its 200-day moving average. In the last 10 years, it's only happened like 4 times. So we have a trigger in our strategy that says, hey, anytime the market moves up so fast that it gets up 10% above its 200-day moving average, we take profits. So in January, we took 33% of our overall stock exposure off, and that was sort of a profit-taking experience. We did not know that the market was going to fall so far down from that moment. We just knew that at that moment we should lock in some profits because it's historic to get that kind of run up that quickly. Fast forward 45 days later, at the end of February, the market does fall on the COVID-19 fears, and it drops down to its 200-day moving average, and we actually trade right below the 200-day moving average because there's a lot of trades that happen at the 200-day moving average that can get you caught up getting in and out and getting in and out. We don't want to do that. So we're under the 200-day moving average by 3% on our outbound trigger. We also have triggers set at the 200-day moving average plus 5 days, or 200-day moving average plus 6 days. So again, we're just trying to wait out the volatility that happens right at the 200-day moving average. But you can see these 4 red arrows show you when we departed the market in different percentages from January through March 13th, right? And so as of March 13th, we had, in our trend strategy, we had no exposure to stocks. We had moved completely over to short-term bonds, things of that nature. Now, on April 1st, another anomaly happened. That is the S&P 500 traded at 20% below its 200-day moving average. Again, another phenomenon that is very, very rare in history. So, and when we see that happen, it's similar to taking profits when it jumps above its 10% above the 200-day. We feel that there's an action needed that makes sense from a discipline standpoint. So we actually put 10% back into, we actually found a structured product that would give us up to 15% of the market's upside, but it would also give us a 0 loss participation in the next 15 down. So it's kind of like getting back in, but getting back in with some almost like bumper guards in the bowling alley lane. You can't throw the ball in the gutter if you've got the gutter guards out. So we bought an ETF that gives us some structured outcome, and we feel like that's going to serve us well to just have taken advantage of that minus 200-day or the minus 20 to the 200-day moving average. But trend is part of our strategy, and by trend being a part of the strategy, what it allows us to do is participate on the upside most of the time, because most of the time the market trades above its average, right? But it allows us to be out when there's drama or turmoil or uncertainty or decline or panic or fear selling. It allows us to just be out of the way for most of that. And we believe that that is a great formula to have a disciplined approach to how do I keep my mind focused on the long-term goals of accumulating shares so that I have money in the future to retire on when I'm selling those shares later, but at the same time, sort of capping my loss potential on the downside, that we know you cannot lose but so much if we're coming out at the 200-day moving average or thereabouts. So keep in mind with the trend strategy that we don't run that 100% in all of our accounts. I mean, the more aggressive clients, by the designation of being aggressive, want to own stocks regardless, whether it's good, bad, or indifferent. So the trend component of the stock portfolio of a more aggressive investor is minimized, right? Whereas for a more conservative client that maybe doesn't have as many stocks in the first place, maybe all of the stock exposure for our most conservative clients is set up in trend. So there's a vast array of utilization of trend strategy, but we think in this moment, in this cycle, in this pandemic, that this strategy is very, very valuable. So I'm going to move on. We're going to move into a next section here, and this is just kind of, we did some Q&A. Some of the questions that we got in the Q&A on the call today had to do with, how long might this last, or how bad can it get? How much could the market go down? And we don't have a crystal ball. We don't know how much it could go down. But what we do know is that regardless of how much it goes down, the strategies that we're using enable us to be in a position to gain from further declines. It also allows us to protect against larger losses to some degree. And it allows us to be patient. Like, we're not trying to time the bottom. We're not trying to pick the worst day. We're going to wait until the market finds a bottom. It retests that bottom a couple times. Some time passes. The 200-day moving average slides down to meet it. And eventually, when that retrenches and recrosses, that will be statistically about the right time to try to begin reestablishing positions that we want to own for the long term. In the meantime, we're hunkered down in the bond market. Now, one of the questions that we got was about the bond market. We've seen some kind of turmoil this year in the bond market. And the bond market has two sort of sides to it. It has the government side and the corporate side. And so when we got into the fear-based selling that comes from the overall market dislocation in March, what we also saw was that corporate issuers of bonds had pricing anomalies. We started seeing investment-grade corporate bonds having to be sold at 96 cents on the dollar, 97 cents on the dollar, because so many people are trying to just get their cash together. Get me out, doesn't matter what it is, sell it all. And unfortunately with the bond market, there are so many trillions of dollars invested in bonds that when suddenly a lot of people want their money at the same moment, it's almost like there's only so many exits from the arena. And so the people that are buying bonds in those moments have the opportunity to discount what they're actually going to give you cash in those moments of turmoil. So the corporate bond market saw some declines in the first quarter. They seem to be stabilizing this last week or so, but it was noticeable. And then, of course, the government bond market, that piece has actually done very well year to date, because there's this flight to safety. You take your money out of stocks, take your money out of commodities, take them out of energy, take them out of real estate, take them out where you want to take them, where are you going to put it? The safety trade tends to be U.S. Treasuries, U.S. government obligations, that kind of thing. So those were some of the questions. And then we moved into our next segment of our session. The views of those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 is an unmanaged index representing the largest 500 companies in the United States. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance does not guarantee future results. All investing involves risk, including the loss of principal. There is no assurance that any investment strategy will be successful. Thank you.